Hello, welcome to this episode of Rich Insights. I'm Don Rich, the Chief of Investments or the CIO of Esoterica Capital Management. Today's topic is wrap yourself in a flag. All right, red, white, and no blues. What we're talking about here is domestic investment versus foreign investment. Now, one of the key differences between domestic and foreign investments, of course, has to do with the currencies. And currencies are probably the most opaque or most difficult aspect for most people when it comes to investing. But, of course, we're going to make it simple, right? That's what we're here for. We're going to break it down and make it simple. All right. And the thing that makes currencies difficult is that market convention is all over the map. All right. Currencies are quoted in a variety of different manners. Forget about market convention. That's the advice today. If you want to simplify currencies, forget about market convention and quote everything in dollars. All right. That will make things simple. All right. For instance, think about a share of Facebook, for instance. All right. What does Facebook cost? It costs about $200 a share. Right? That's the way we think and talk about Facebook. We don't think about Facebook as being 0.005 shares for $1. It makes you scratch your head and wonder, did he pop the cork early today, or is he getting into some of those funny cigarettes? No, I'm not. Again, if we think about currencies the way we think about everything else, they're simple. Facebook's $200 a share. If we quote currencies always in dollar terms, we get the same result. Okay, now so far, in terms of dealing with currencies, they've been in the news a lot lately, all right, in terms of current events, because the President Trump has repeatedly requested or desires a weak dollar, a weak currency. Now, that may seem counterintuitive. Why would he want a weak currency? We are a consumption-based economy. We live off our imports, right? Most of what we consume is imported. And those imports become more expensive when the currency weakens. It's just like a tax, right? The price of the goods on the shelves at the stores we buy at go up when we have weak currency. Why would the president want a weak currency? Well, what he's thinking about is the flip side of that. He's thinking about exports, right? Exports are attractive for consumers in foreign countries when you have a weak currency. Exports are attractive for foreign consumers. All right, now you put the two pieces together. If you got a weak currency and your exports go up and your imports go down, well, then you get a higher GDP number, right? You get better growth. That's what the president's thinking about. All right, but that's not what's happening. We're not seeing a weak dollar. All right, so let's go to the charts. Here we have the euro dollar. Right? Euros quoted in dollars. And again, when this chart goes down, it's just like our Facebook chart, right? If we hold Facebook and we're looking at this, we lose when the price goes down. Well, it's same effect here. We're looking at the value of euro. So when it goes down, that means the euro is weakening or the dollar strengthening. All right? So you can see this tremendous move we've really had so far this year. All right, it's been on the order of about 3.5%. Right, a big move so far this year. All right, and let's widen that out a little bit here. Going back to the start of 2018, you can see this dollar strength has been pretty consistent here for the last couple of years. This isn't a recent phenomena. We're up 10 or 12% in the last 2 years here. Okay, so what do we do with this information? We have the dollar strength. All right. The first thing we know is that we're likely to see some softer GDP numbers coming up. All right, that's the first thing. All right, we already talked through why that's going to be the case, but you should be expecting some softer GDP numbers coming up. Right? That's not good. But what does it mean for investors? Right? What does it mean for investors? Well, if you're a foreign investor, investing in the U.S. right now is a great time. Right? Just think about this. If the euro's moved 3.5%, and U.S. stocks are up 3.5%, you have doubled your return. Foreign investors investing in the U.S. have doubled their return so far this year by investing in the U.S. Right? So this strong dollar environment attracts a lot of foreign capital flows. It's great for them. What about for us? For U.S. investors thinking about investing abroad, it's terrible. Right? That 3%, 3.5% currency move acts as a tax. All right, the way to think about that is if you get 3.5% return on your foreign investments, you give it all away when you translate those back to dollars. All right. So right now, it's not a good time to be investing abroad from an earnings perspective, right? The earnings profile of U.S. companies is much better than non-U.S. companies. We've looked at that before, talked about that before on a previous segment. And from a currency perspective, it's also a bad time to invest abroad. So the message today is very simple, very clear. Stay home. Stay invested in the U.S. Stay with what has been working. We would expect it to continue to work. All right, I'm Don Rich, and you've just experienced a rich insight. Thank you for watching. We'll talk again soon.